Welcome back to the BDSM show, where we talk all things budgeting, diversification, savings, and money management. This show is part of our brand new and exciting B project, which you will be hearing about before this year is out, and I will be saying that every single week until we actually finally reveal it. Hopefully, it is this week. Otherwise, you will all laugh at me. My name is Ivan, and considering more and more people are joining in every single day, I can only imagine that you guys are actually interested in all things BDSM. And in case you don't already know, all advice today is general only. Today, we're focusing on Robo-Advice, what it is and whether it's right for you. I'm joined by Pat Garrett, co-founder and co-CEO of SixPark. Welcome to the show, mate.
Great to be here. Thanks.
Thank you. Well, Pat's got quite a pedigree within the financial services industry. 15 years at JP Morgan, across the globe. You've already probably sensed the slight American accent. You've almost lost it, so it's fine. There's 8 years running a private equity firm, and then in 2014, it happened. You decided that it's time to start something new, and you co-founded SixPark, which is a modified version of Robo-Advice, and you've really been going from strength to strength. 2016, I hear you got a whole heap of really big investors piling in, and their hypothesis is that the future of advice is already here. Driven by core objectives of simplicity, practicality, low fees, and high-quality risk management practices, plus the market intelligence of the experienced team behind SixPark, it really feels like you guys are the future. So tell us, what is Robo-Advice?
Yeah, thanks for the intro, Ivan. I think Robo-Advice is a term that has, for better or for worse, sort of encompassed a lot of different things. But basically, at its core, what I'll refer to maybe as digital online investment management is a way. What we've built is a service that helps clients in a very accessible and affordable way construct a diversified portfolio that, based on an assessment that we provide, we believe provides the right balance of risk and reward. We use exchange traded funds to construct the portfolio. We use technology and automation to deliver the service in an efficient, affordable way, but we have a very high quality human overlay in the form of asset management expertise to effectively put the inputs into the automation. There are no robots involved. It is highly technology driven, but there are very qualified and experienced people that are behind the service and really helping to kind of drive the portfolio construction for portfolio management, the ETF selection. And one of the reasons when Brian Watson, my co-founder, and I set this business up, maybe it's worth stepping back on a little bit on the why.
It's the best topic.
Yeah. Well, what we could see in short was it was too hard, too expensive, or too difficult for most Australians to access professionalized investment management help, and most wanted or needed that help. But there weren't services out there that could provide it. And around 2014, when we saw this, and candidly, we saw it personally and professionally. We were in the financial services industry, though not at the financial advice end per se, but we could see what was going on. And then personally, I had a lot of people, family included, saying, "What should I do with my money and how should I invest it?" And I really didn't want to tell people what stocks to pick and whatnot, because that's a very tough game, as the data would suggest. Active stock picking is a tough one. So the concept of using exchange traded funds to build, as you said, built on the core principles of simplicity, investment diversification, and keeping costs low, was what we thought the Australian market and the Australian consumers really needed and really deserved. And the ETF market was growing in Australia at that point. So the investment vehicles to create these portfolios had grown. Technology and the use of APIs. I didn't know what an API was 6 years ago. You'd know a little bit more about that than I do. But the ability to construct the technology modules that go from taking a consumer from a website to a risk assessment to an automated generation of an investment recommendation based on those answers, to then opening an account, a cash account and a brokerage account, and then actually investing the portfolio and doing things like rebalancing and giving people the ability to change the portfolio as if and when they need it, as their life circumstances might change. If you do that well with technology, it's not all that simple under the bonnet, but it should be and can be simple for the end user, and that's what we wanted to provide. That had happened overseas in the wake of the GFC, which didn't really impact Australia quite the way it did overseas, which triggered the birth of technology-driven investment management services. But the Banking Royal Commission was kind of like the GFC moment here. And COVID, for better or for worse, for all the wrong reasons in some ways, has accelerated the kind of the desire for digital solutions. So that's really kind of the why and how it works. And really what we want to do is get more and more people that want or need help with their investment management.
And I'm going to drill into that in a second. Now, by the way, if this is an interactive session, so if anyone's got any questions, type them into the chat box. We are running a poll at the moment. Have you previously invested through robo-advice platforms like SixPark? 28% so far say yes, 71% say no. So this might be awesome. I know that I asked a few people about, what kind of questions should I ask someone who, people who don't really know a lot about finance, such as my wife. And the first question was obviously, what is robo-advice? And second one was, is it applicable for me? Is it a secure thing? So tell us a little bit about that. The slogan on the front page says, it's humans, not robots. So it's robo-advice, but it's a human inside the robo-advice. So how do you guys pick the ETFs? How do you pick the portfolios? And how do you get such awesome results that you've had in the last couple of years?
Well, we've got we have what I would say is a fairly wholesale level of rigor on the analytics of the selection of ETFs. So we select ETFs based on fees is one aspect, but track record of the issuer and of the ETF, and bid-ask spreads, liquidity in the market, size of the ETF. And really, if you want to maybe take sort of more of a top-down, what we've done is we've determined what asset classes we think make a well-diversified portfolio, ranging from kind of cash yield and bonds through to Australian international equities and emerging market shares, infrastructure, property. And the human overlay is that we have an analyst that works with us who's incredibly qualified at researching the ETF market, which we review on a monthly basis. And we have an investment committee, which comprises my co-founder, Brian Watson, who was one of the founding members of the board of guardians of the Future Fund. So in short, effectively kind of giving asset allocation advice to the Sovereign Wealth Fund. Mark Nicholson, who was
not a small job.
Yeah. Mark Nicholson was a co-chief investment officer of the World Bank, and Lindsay Tanner is the ex-finance minister of Australia. And that's not a token investment committee just to put some names up there. They, with management, meet on a regular basis to review our portfolio constructions, the ETF landscape, the global market landscape, our asset allocations, the performance of our portfolios. We've got a very detailed foreign exchange policy that we review to see how much hedging or not we have or want in the portfolio. But what we don't do, Ivan, is tinker a lot with that. Tinkering is what we think gets investors into trouble, because patience is definitely a virtue on the investment management side. So we do make changes when we feel like there are fundamental structural things that are changing in the market, or a new asset class surfaces with an ETF endpoint that we can use. But it's really the asset management experience of the people involved that generate, I think, there's a lot of reasons why I think people like our service, but ultimately they want to get good returns on their money. And the combination of low fees with that human overlay, I think, is what really gives value for money, which is a big thing in the financial world right now in Australia. Value for money, and I think we do that.
And also, low fees are a big thing, right? I mean, people talk about how the impact of 1% is going to be over, a portfolio that continuously grows. The compounding interest, the interest of that is a big deal. And you guys obviously have a significantly lower fee proposition than a managed fund, even when you take into consideration the underlying ETF fees. Actually, two questions for you. Firstly, just a quick question around what are ETFs for those that don't know, and then how does that improve your portfolio overall?
Yeah, so an ETF is an exchange traded fund or an index fund, and it's like a managed fund in that it is a basket of investment securities, but unlike an actively managed fund where some professionals are paid to try to pick which securities to own and not own, it actually just tracks an index. So the easiest way to describe it is, what is an index? An index is the ASX 200, it's the S&P 500, and then there's a lot more than that. But it's a fund that is effectively set up to mimic that index. So you're buying, a whole region or a whole market or a whole index through one fund, because underneath that fund, it basically replicates that index. There's the key advantages of that are you get basically investment diversification through buying one security, because it'll have underneath it a variety of holdings. Two, it's very low cost relative to a traditional managed fund, because there isn't daily trading and activity to try to, in the process of buying and selling shares, it is a lower overhead investment vehicle, so the costs are very low. So what they are quite good at is constructing a portfolio of asset classes, and they don't claim to outperform the index, but to rather be able to provide strong risk-adjusted returns.
And obviously, just to go for the more advanced people in the room, obviously you pick ETFs that have minimized tracking error as much as possible, or seek to minimize tracking errors. So in other words, the ETFs are actually a really close reflection of the way that the index moves. I think you've got some cash ETFs in there as well.
Yes.
So it's a pretty diversified portfolio. The balances that you've got in the account, or the clients that you've got, range from really small to like multi-million-dollar clients. I mean, that's an extremely wide variety of people that have effectively entrusted you with that. Where is the barrier? And if this is so awesome, why are there not more people having exposure to Robo-Advice, whether that be in their entire portfolio or a portion of it?
Yeah, well, I'll touch on the first point of that wide range of clients, because I think you sort of alluded to it in a previous question. Prudent investment diversification at a low cost should appeal to all investors. It should appeal to somebody that's got millions to invest. It should appeal to somebody that's just getting started on their investment journey. So I think that's probably at a very high level why we have resonated with people just starting their investments, as well as high net worth individuals that want some or all of a portion of their investment management to be done in a manner in which we deliver it. There's probably a couple reasons why the penetration rate or awareness or uptake of Robo-Advice in Australia has lagged overseas. One is what I alluded to before, in terms of the GFC being a triggering event, and that didn't sort of happen here as much. Another is that the financial services industry in Australia here is unique, and there's a pro and a con to this, in that it's really largely focused on 4 large institutions, and those institutions, for the most part, haven't historically had any strong desire or need to want to roll out a product like this when they're effectively making a lot of money in operating their businesses in the status quo. Whereas overseas, large institutions recognize the need to adopt a digital solution to meet the mass market needs. So, consumer awareness was driven by a lot of the providers offering it and putting it out in the market for consumption, so to speak. That really hasn't happened until recently in Australia. I also think a part of it is that somewhat unique to Australia with the superannuation configuration that exists in Australia, which is terrific, and it's fairly unique. At the risk of generalization, the concept of relying on your super for your savings later in life, saving some money in what could have once been a relatively high yield cash or savings account for your first home deposit, and then having a majority of your kind of wealth through property and hard assets. That's kind of the way the world worked for most Australians in the past. In the last couple of years, that's obviously been flipped on its head. Housing affordability has gone through the roof, and interest rates have gone through the floor. So what do you do with your money if you don't want to have it in a sub 1% savings account? And so what we've seen recently is an acceleration of the awareness of the online service. I'll say Robo-Advice, although for the sake of timing. What we've seen is the awareness actually has started to accelerate in the consumer space. Where it's really started to accelerate out of that we've seen is because we have a B2B solution now as well. And it's pleasing to see that where we're seeing acceleration of note is within sort of the financial advice, accounting, and then some other entities that have a consumer relationship and the right to offer a service like this. Because there's a massive amount of transformation going on in the financial services industry in the wake of what's happened in the last year or two. There's a massive wealth transfer that is going to happen in the coming years from the baby boomers to the next generation of investors. And so wealth firms, banks, financial advisors, and accountants need to prepare for that. And they need to do it now, not later. And so what we're seeing is a year ago or 2 years ago, when we would have a conversation with a wealth firm and say, this is what we do, this is how we can complement your business. We would frequently get feedback that was of the frame that we were more of a competitor or we were going to cannibalize some of the business. What we're hearing now, which is good to hear, because it's the right answer actually, is that we are actually complementary to what most wealth firms do, in that we are actually providing a service to a consumer before a wealth firm would actually have the conversation with that person. So if somebody, to use an example, if somebody with $200,000 walks up to most wealth firms or advisors in Australia, they actually get turned away because the advisor doesn't view them as large enough, which is sort of a crying shame. That's actually starting to change quite significantly. And we've lined up a number of arrangements with wealth firms. We just announced yesterday a partnership with an entity called Roll It, which is a financial wellness platform, where we are going to be the investment management piece of that service. That's a long-winded way of saying I think the uptake, the awareness, and the utilization of an online investment management service is going to accelerate and is starting to accelerate rapidly now in the market. Right.
Well, it's almost like the world is actually waking up to it. And, one of the questions that was asked internally is robo-advice killing traditional advice? And I think you've started alluding to that. By the way, just quickly, we are doing another poll just before you answer that. Have you ever automated any form of investment? So 22%, by the way, people did say that they have invested in Robo-Advice on the call. 28% of the people so far are saying that they have automated an investment. But actually, just maybe something a little bit more interesting is that the typical client, when they go on and give money, is it really something where they go on and say, I expect that every month you guys are going to deduct money from my account, or I'm going to put money into there, and it's going to go and kind of have that grow? Is that sort of the mechanism behind, or the strategy behind someone investing into a robo-advice platform?
Well, it can be done any variety of ways. Somebody can invest a certain amount of money with SixPark. We will set up the account. It's a HIN-based model, which means that the assets are all held by the clients. We don't pool funds with other clients.
Which is unique for Robo-Advice, generally speaking.
Yeah, and we've found that generally people want to know that they are the beneficial owner of the investments that they make. So what we're doing is effectively just facilitating the opening of an account and making the investments, buying the ETFs in the different asset classes according to their strategy, and then rebalancing, et cetera. So somebody could open an account with SixPark, and we've lowered our entry point from 10,000 to 5,000 recently, in part because of what's going on with some of the COVID and people becoming day traders, but we can talk about that if you want in a moment. But somebody can open an account, put money in, and effectively stop there. And over the course of time, dividends will land in their cash account. And as those build up, they will then get reinvested in a rebalance transaction. And we do that. That's part of the service that we provide for clients, is as cash builds up or deposits are made, we will periodically reinvest that into the market. That's actually quite a powerful mechanism for anyone that has a medium or long-term investment horizon, is to keep it's effective dollar cost averaging. So we have clients that'll put in a lump sum at one time and that's it. We have clients, and we think this is really smart for people, who will make an initial investment and then basically set up a direct deposit into the cash management account that's linked with their SixPark account. Again, it's their account. They can do it's a Macquarie CMA. They can make a direct deposit into it. So the number of clients that we've had that have, say, started with a $10,000 investment and 12 months later have several $100,000 invested is substantial, because not surprisingly, people will test things as they do, especially if they're trusting somebody with their money and their savings. But when they see the simplicity of it, and they see that they can log on and see what they own, when they know that it's in their name, when they see a reinvestment or rebalance trade happen, and they realize, oh, I've actually bought more shares with the cash. The simplicity and the beauty of it, which it's the kind of thing that Warren Buffett talks about, is most people should be investing this type of way. People then do tend to, the top up rate for our accounts is quite high. People start, but then add more over time. People can obviously also take out funds. We are not like a managed fund that says you have to give us 30-day notice to take money out. You can pick up the phone and call us and say, I'd like to either close my account, or I'd like to take out a certain amount of dollars, and we will either that day or the next execute the trades based on your instructions. So it works the other way as well. But transparency is really the main thing, and an effective communications and engagement is what builds that trust. So we do find a big majority of our clients do tend to add money over time.
Yeah. And
the last bit you asked, Ivan, our fees are $9.95 a month for up to $20,000, and then they starts at 50 basis points annualized, down to 30 basis points depending on the size of the account. We take that fee out of the cash account on a monthly basis. So there's always a little bit of cash in the CMA, and we withdraw the fees on that part. So a $100,000 account, the SixPark fees are 50 basis points for $500 a year, and that includes
which is really the service for managing a platform, growing the platform. You guys actually doing the rebalancing, having your crazy panel of superstars and former government advisors running that. That's interestingly enough. So a couple of questions that came through, and some private, so you can't see them, but two came around the minimum entry, and the comment around minimum entry being lowered to 5K from 10K. Is now a good time to start investing, or should you wait after COVID, whenever that is?
Yeah, I think if you have a medium to long-term investment horizon, the answer to is now the right time to start investing is almost always going to be yes. I recognize that, because if the answer is no, that means you're trying to time when to get in and when to get out. And when the market had fallen in Feb and March by 30-some%, and a lot of people sold because of what they were afraid was about to happen and get worse. Not many people would have thought that, oh, the market's about to go up 30% real quick. Timing the market's quite hard. So my answer to the question is, it's always a good time to invest in the market if you have a medium to long-term horizon. Your asset allocation is an important aspect of how you invest, because investing doesn't just mean buying shares, e.g. taking on growth and risk assets. Investing means having a diversified portfolio. So you can actually have a relatively low risk investment right now if you focus on bonds and cash yield and whatnot. The second part to my answer to that would be, you don't have to invest everything. If you have $100 to invest, making up a number, you can put a portion in today, a portion in 3 months, and a portion in another 3 months. If you are concerned that the current backdrop is cause for pause, it isn't binary of put all in now or put all in later. You can drip feed over time and get the benefit of dollar cost averaging.
And that's ultimately the strategy behind even people that invested in 2008 when everything, it's riveting to me having a conversation about Robo-Advice, because, I reckon about 2 years ago, we probably would have had a very different conversation. Now knowing what I know about the market and the makeup, I come from a full-time trading background, it was a futures and options guy. So for me, it's like, everyone should be a day trader. And then I saw what happened in the last 6 months and 9 months and got exposure around this. And I get a pretty good understanding why really a lot more people should be considering things like Robo-Advice, and in particular products like what SixPark offers.
Yeah, we obviously have an investment philosophy that centers around what's been articulated. And we think, but we're also advocates of hub, spoke, core satellite, whatever you want to call it, where, and we have a lot of clients. We've got a lot of SMSF clients that, by definition, since they have an SMSF, that they want to have something along the lines of active control of their investments. And an active decision can be to use SixPark. But they might have some investment interests that they want to pursue outside of something like what we do, but they use SixPark as sort of a hub or a core and then do things around it. And that's just a risk management strategy. And so, like I said, it's not sort of binary. As I see low-cost trading services emerge, like open markets and others out there, I think it's great. I think the fact that younger people are getting into the market and trading individual stocks, in theory, is great. They're getting engaged.
In theory.
They're saving money, right? Whereas otherwise they may not have. They're looking to see where they can, grow their wealth and thinking about things that they previously weren't. But it is a dangerous playground. And so I just think there need to be some rails around how people, if they're going to, pick stocks, having some risk management strategy around that, particularly if you're doing it with, it was pretty unique when I think it was, ASIC and the RBA came out with the warnings you'd be familiar with a couple months ago, when the number of retail accounts
ballooned.
Ballooned quite substantially. And I forget whether it was ASIC or the ATO or the ASX, but there's visibility to see how people were doing, and a lot of people were losing money.
Mm.
A lot of retail.
Not if you read Reddit forums. Everyone's winning money. Everyone's making money.
Well, I think you tend to hear about the wins more than the losses, but the reality is that active trading, I would never discourage anyone from doing it as long as they know what the risks are. And as long as I think they have
prudent risk management, trading plans, and ultimately probably have some understanding of what a investment pyramid is, and how where you should be exposed, and that you don't put, your house, your relationships, your family in sort of effectively, bet it on a pair of pocket twos. In a poker game, right? So we're running another poll. When might you consider investing with SixPark? I think most of you already have answered, but 14% said they're interested in doing it now, 42% in the next 6 months or so. And for those that are watching this on replay in some future state, I apologize for you missing out on these polls, but that means you need to be on the line at any given time. One of the guys on the line posted a private comment. Robo-Advice will put full service advisors like I used to be out of a job in a matter of time. Kieran also does work with us, so I thought I'd just push you into that. But put you to the spotlight. But interestingly enough, I think that the message that I've heard you say over the last, to be fair, I've only known you for about 8 months, I think, since I sort of got involved in open markets, and it's interesting. What you're saying is really that they should be sitting side by side. That there is a space where full service financial planners, full service advisors, financial planners, robo advisors, all fit within the world of the wealth ecosystem. Do you want to talk a little bit more about that?
Yeah, I'd love to, because I think that's incredibly topical right now. If you think of the wealth journey of a consumer from the time that they start paying off their debt and credit cards and start saving some money, through getting a raise and starting to save a little bit more and accumulating funds, and then getting into the more complex part of their wealth creation journey, where some more difficult decisions, they're starting families, they're starting to think about estate planning and a few other things. Right now, most financial planning firms engage with people at a certain point during that timeline. And it's because it has become increasingly expensive to service clients for financial advisors. There is a major supply-demand disconnect happening in the market right now. The number of financial advisors is declining rapidly. The number of people who could probably use help with financial advice is increasing, for a number of reasons. So what's the answer? One answer is that Robo-Advice can sort of stand alone on its self and provide service direct to consumers. We're doing that now. That's what we've been doing for 4 years now. Another is that services like SixPark can work with advisors to effectively be a service that they can provide to people earlier in their wealth creation cycle, to engage with them and effectively provide them a service that is a step away from sort of the more holistic, real value add that, I've never ascribed to the concept that Robo-Advice is going to put the human advisors out of business, because you can never automate what a good human financial advisor does. It's invaluable. And we don't claim to do that. And we want to be complementary to that. What I think most financial advisors would agree with now is, in the past, I want to say they've gotten away with, they've been.
We know what you mean. That's okay.
Asset managers in their role as a financial advisor. And the reality is, a financial advisor really shouldn't be an asset manager. They should help a client understand all the dimensions of their financial situation, important decisions, and the likes, but they shouldn't necessarily be picking stocks or ETFs or whatnot. And
they definitely shouldn't be doing that.
No, it's not where they add the most value. Where people really need, value is when they get to critical junctures in their life and they have to make decisions where emotions can really come into play. And an advisor can sort of talk them off the ledge at times, or get into some of the really technical things of estate or tax planning and whatnot. And the accountants fall into the same category as well. We have a lot of alignments with accountants now. And so just sort of circling back, what we really are is sort of an incubator of future full service clients for a wealth firm. And so it is phenomenally complementary when you sort of sit down and sketch out a consumer journey of, you know, the early days through to when they need face-to-face help. We fit into one segment where they can engage and provide value for money that currently they're not able to do. And that segment is the segment that's about to inherit a lot of assets.
Biggest wealth transfer in history.
The biggest wealth transfer in history. So what we're trying to do is go out and what we're not trying to do, we are doing, is going out and talking with wealth firms that are thinking about this stuff, I think, in the right way, and saying, we're not trying to take your existing client and move them off something into something else. Though candidly, a number of the use cases are the wealth firms actually using us for part of some of their high net worth individuals, because they can say to them, see, we're using a digital service with really credible people at a phenomenally low price point as part of the service. And that makes a richer, deeper, more trustworthy relationship with that client. But the main thing is, as I alluded to before, it's the person that has a few $100,000 that's currently getting turned away, when the advisor would like to say, actually, I can provide a service. It is not the full-scale, holistic soups and nuts. That's the $4,000 or $5,000 SOA to do everything. You don't need that now. You're actually not asking for that now. Here is a service that you can look at and use if you want. It's and I guess probably the most salient point to make on this, to demonstrate this, if you look overseas, JP Morgan, Goldman Sachs, Credit Suisse, Bank of America, Fidelity, Schwab, Vanguard, BlackRock,
Morgan Stanley,
and I haven't even gone into the UK yet, or the other parts of Europe. Every major financial institution overseas, in the US at least, has something resembling a low-cost, low-touch, I would say professionally managed, because the concept of using ETFs and rebalancing and portfolio diversification, to me, that isn't like a starter kit. It's actually quite good. But the ability to deliver it in a digital way to that younger cohort, or that lower need, it's not always low value. Sometimes our first $1 million client, I was not somebody that you would say is a low value client, obviously, but their need was simple. They just wanted investment help, and they were getting $25,000 quotes from wealth firms, because it was, once you added everything together, it was 2.5%, and all she wanted was to get investment help, and it was 30 basis points or $3,000 from SixPark. So
just a massive difference every single year.
It's a huge difference. And so overseas, that transformation has happened to where the institutions and the wealth firms have realized this needs to be part of my toolkit, and that's kind of what's happening now here.
We just slightly went over time, and I just want to maybe press you for a couple more questions before I do let you go. But for anyone who needs to go, if they're on their lunch break for things like work or whatever, type in yes if you want to get access to SixPark, or go to sixpark.com.au. So if you type in yes, we'll pass on those details over to Pat and his team if you want to have a chat. Just do that. But a question from Brian. Hello, Brian. Brian's an options trader. I know Brian very well. How does this differ from investing in a well-managed LIC that has a DRP? A
well-managed LIC. So I guess it depends on.
Aside from maybe going on the AFR and reading all about how well LICs have been managed.
Yeah. Let me maybe try to answer that a slightly different way, because this question comes up a lot. Vanguard has model portfolios, right? You can buy a Vanguard balanced portfolio that puts together 6 Vanguard ETFs. We get asked all the time, how do you guys? Why wouldn't somebody just go do that? And there's 2 really important answers to that. One is you have to decide which portfolio is right for you: low risk, medium risk, high risk. We actually have an assessment that is one of what we think is the most important parts of. We actually try to help you figure out what kind of risk profile you should be adopting. And 2, we're product agnostic. And by that, I mean, a Vanguard model portfolio is only going to use Vanguard ETFs.
Yeah.
We use whatever ETFs we decide are the best ones in the market. Vanguard's phenomenal. We use a bunch of their ETFs. Their model portfolios, last I looked, don't include, infrastructure as an ETF, as an asset. We think it's a great asset. So we think that product agnosticity and the fact that we have a tool at the front end that helps you figure out actually what risk profile is more suitable for you is what makes it different than, say, going on to whether it's a LIC that rebalances or just a model portfolio that might be sitting on a platform somewhere.
And what does the experience look like? So you go into, as a client, you go into SixPark, you go through the quiz. I assume that entire process is free of charge. You actually can go on and engage with the platform, and then only really the fees kick in at the point that you choose to invest. And they're so small that it almost is a no-brainer. But anyway.
The answer is that you can go onto our website, take the risk assessment, and get a recommendation, and you're not committed to anything. You can then open an account and put cash in, you can then open an account. You only will get charged a fee when we've invested funds. We don't charge fees for people opening an account and for us not doing anything. We only charge a fee on the invested assets once we've actually started.
Open markets, where's that cost? It's fine.
Yeah, exactly. So we get asked a lot, well, why don't I just go to your website, take the assessment, find out what you recommend, because we'll tell you what ETFs and we'll tell you the asset allocations. So one of the questions a lot is, well, why don't I just do that and then go out and buy the ETFs myself? And the answer is, well, the fees that you're paying us includes brokerage, because we've got a really good brokerage partner that we like working with in open markets.
You're welcome.
So if you want to do it yourself, that's fine. You've got to go out and execute the trades yourself. We have a very sophisticated way of monitoring drift and rebalancing portfolios when that's necessary. If you want to manage that yourself, because it is an important part of portfolio management, go for your life. And if you want to be the one that's continuously reviewing, one, should the asset allocations change over time? And 2, if
doing the rebels.
And candidly, one of the things that's probably, and I alluded to the behavioral part of investing, which can't be understated, Ivan. One of the things that's probably of most value in a service that we provide, given the people, and we have a really engaging communication strategy with our clients, telling them what we're doing, why we're doing, what matters in investing, what our investment committee is thinking. What that does is it builds trust by our clients that the system and the service works. So when the markets had their wobbles in late Feb and early March, we were really keen to see what's our client behavior like. Because some people were making the case that, well, these online things are going to fall over when the shit hits the fan, excuse me. And what we saw was
our first show, there was blatant swearing. It's fine.
Yeah.
I mean, we call the show BDSM. You know what I mean? Like,
I'll stay away from the F-bomb. What we saw, Ivan, which was really pleasing. We saw very low churn. We saw some people retake their assessment because if you lost your job and some bad things happen, your risk profile probably should be reviewed. And we saw people topping up their accounts. that actually increased. And the combination of those things was really pleasing because it suggested to us that what we're doing is working and that people trusted the service. And there is no better affirmation for us that people are trusting the service. We are asking people to give us their money to invest, and we're in the trust business. And that's why I think we're resonating well on the B2B front, because advisors and wealth firms are saying, okay, if we're gonna partner with somebody to be our kind of pipeline of future clients, we don't want a bucket shop. We want a really professional firm that we're happy to align with. And I think that's really held us in good stead on that front.
And it sounds like that's exactly what you've put into shape and place. Yeah. Patrick, thanks so much for coming onto the show. I'm glad I found out that you're about within a 5 kilometer radius, so we can actually go and enjoy takeaway coffee in the next week or so. But thanks so much for coming on the show. I wish you every success in the short term until I speak to you over coffee, because I'm sure we'll find some ways of further integrating your business within us. And I'd love to see how we can do some broader things together. It's been awesome to listen about Robo-Advice. For anyone that does want to go on and check out the service, SixPark.com.au. I hope I got that right, didn't I?
You did. SIX, not the number.
SIX, exactly. Yeah. Or just type in yes, and we'll pass on those details. Thanks so much, mate. We look forward to hearing back from you probably in the next couple of months, and we'd love to hear the follow up to this and a bit more detail around it.
A pleasure. Thanks for having me.
Thanks, mate. Chat soon.
Yeah.